So first, the most important thing for me, no matter what I'm trading, is my level 2. Level 2 is always going to be kind of my eyes and ears into the, what the price of the. So what I'm going to do, I'm going to set up a level 2 box on each page, each 4 pages here. And each page is kind of going to be dedicated to a certain stock, okay? And so let's say Apple. Okay, that's obviously a stock that is a great trade for options. So then underneath that, I need to know the prices of the options on Apple. So I'm going to have an options chain here as well, so that I can easily monitor Apple's level 2, okay, as far as what the price of the stock is doing. And I can easily parlay that to the price of the option, okay? And what this is going to help you with, since it's very hard to calculate, the real value of these derivatives at what time and all that, what this is going to help you with is getting a feel for how the option prices move in relation to how the stock price moves, okay? And the things you should pay attention to are not only how does it move, but how does different times of the day or of the week change the way these are moving in relation to the stock itself. For instance, today Apple is at 575, traded between 570 and 580 pretty much all day. Now, tomorrow, let's take these 280 strike calls, for instance, and the 280 strike puts, okay? You watch those again tomorrow, and if Apple were to trade in the same 570 to 580 range and not really, continue to just consolidate from this down move in this range, the prices on these options are going to move very differently than how they moved today. And what this class isn't going to be about necessarily explaining why or how. The purpose of what I'm trying to do is show you how you can understand it in a way that makes sense to you. Because I could say why, and it might not make sense to you. My best advice is to put yourself in a position to learn what makes sense to you. And the way you do that is through proper organization with your quote above your option chain. Then the next thing is going to be our chart, one of our first charts. Okay. So, and I want a couple charts. Okay, the first one I want is the 3-minute. Now, some of you may wonder why I don't use the 1-minute, because I don't. I use the 3-minute, a 5-minute, a 15-minute, and a 60-minute. So any guesses for why I don't use a 1 minute? Yeah, it's a combination of those things. It gets too scrunched together. You get too many different signals. You can find yourself chasing, figuring out the meaning of every 1 minute. I find it much easier to, again, just use level 2 like that. But when I do use charts, I'm certainly not going to use a 1 minute. And again, feel free to organize this in whichever way you want as far as the size. Okay. So I'll make this my 5-minute chart for Apple. And then what I believe is probably one of the best charts to use for day trading is the 15-minute chart. The reason is I don't really know, but it's kind of like sports with 4 quarters. It's like the 15-minute gives you insight into each quarter of that trading hour. So I've just found it to be, I've found myself very comfortable using it as a solid indicator. Okay, and then so those are the main three: the 3, the 5, and the 15. I will use a 60-minute chart as well, but I'll use 60-minute chart more for confirmation. You know, if we're just day trading quickly in and out, that 35 and 15 is going to do you pretty good. But the thing that's nice about the 60, which I was doing today as a matter of fact, take Apple for instance. So this is at lows, right? I mean, on every single chart, we're at lows on Apple. Okay. However, what I like, this is why I like the 60. You can get this from the daily too. If you look at the 20-day 60-minute, you can see we're actually right near, we kind of filled that gap. So, you know, that's something other people might not have noticed today. Maybe we could get a bounce here back up towards 600 or towards the bottom of this gap at 587 or so. Or otherwise, you know, now I'm set up where if I break below kind of the high of this gap, instead of waiting for the low to actually break, I can kind of get a head start on that. So just trying to give you different insight into stuff like that as far as platform based and how you might set it up and what I find each chart useful for. Now, the other thing I want to have when trading a stock like Apple is I want to kind of have a sector view, right? So I want to know also kind of what Microsoft is doing, Google, you know, how are all those names performing? So one of the things I would recommend is a watch list, okay, that you can just kind of keep in the corner. So we'll get QQQ on there, Facebook, XLK, Google, Salesforce, Baidu, Amazon, Netflix, Microsoft. Okay, that's a good starting point right there. So now what I can do with this get a quick view on these other stocks that are in the same sector. And what's especially important about this is now you are keeping an eye on these stocks. So say Apple tomorrow doesn't really move, okay? Now what you can do, oh, and we got to put Apple on here as well. Now what you can do is all of a sudden say, oh, Facebook has earnings tomorrow. Facebook's up 3% after hours, or 2% on the day. You know, Facebook's in play tomorrow for me, okay? Facebook's definitely in play. So now I can change all this stuff to Facebook. Just quickly. And what this might help some of you with is not only getting to know a few stocks, but not being so caught up in trying to trade everything that's moving. Okay, you can't make every trade. But what I recommend is if you have just a few stocks that you follow in particular sectors, you'll be able to rotate between them very nicely, and you might miss other stocks making big moves. But if you get to know 5 to 10 in the tech sector really well, one of those, I can promise you just about, will always be making some type of move in either direction. There will be volatility there, okay? So, you know, that's how I'd recommend setting something like that up for options to allow you to manage your trade. And so on this second page, you know, so first page was kind of technology based. This second page, I'm going to make it financial based. Financial sector has been a good sector to trade. It's been volatile. Just today, you know, XLF, the financial sector was up 0.5%, while XLK technology was down 0.5%. So that's a good mix to have. I'm going to pick Citigroup for my focus here because I just bought some puts on Citigroup today, so I am watching it. Okay. So again, just kind of get the same setup. And then after this, I'll go more into detail about actual execution. And for those of you who might have been expecting a different type of class at the outset, as far as like, oh, I'm not actually learning how to trade options or, you know, stuff like that. You're learning how to be prepared to trade options. And that's the first thing you must do before you can actually trade them. So don't underestimate the importance of being organized and having your eyes in the right places. Okay? Just because you have eyes doesn't mean you can see. That's what separates good traders from great ones. We can all see the same thing if we want. But who was more prepared to see it is the difference between the person who is in Oz and the person who's actually setting off the fireworks. So again, I'll set up my 3-minute chart for Citi across the board here, my 5-minute, my 60-minute. And now, again, I want to have a feel for the sector I'm playing in as a whole. So on this page, I'm going to create a watch list that's going to contain my financials. Okay, so I'll delete QQQ. I'll add XLF, Citi, JP Morgan, Morgan Stanley, Deutsche Bank, BAC, Goldman, Wells Fargo, USB. Yeah, so that should give me a decent outlook. You know, if I'm trading Citi, which is one of the majors, I want to watch the other majors like JP Morgan and Morgan Stanley and all that. And again, just like I showed you, this will help you in that now if JP Morgan's moving, for example, Citibank's been going down the last 3 days, but JP Morgan had been going up the last 3 days. Okay, part of my reason for putting this Citigroup trade short trade on is because I'm seeing into the close JP Morgan is kind of falling off. Okay, JP Morgan led Citibank higher, right, over the last couple of days, but now JP Morgan looked like this rally might be coming to an end. So that's why I was shorting a name like Citi on a green day today. But and again, that familiarity, I don't think I've ever bought puts on Citi before, but because of my familiarity with JP Morgan, I'm able to just enter the trade comfortably. And that's because of how I have things set up. Now, say you want to add other level 2 boxes, you know, say you want more of an actual feel for the way a stock is trading on that particular day, that's fine. Just add some more level 2 boxes and place them where you'd like. Okay, I was watching Cat today and Google. I'll just move them on down. Okay. Now, again, that's your choice. Whatever you want to put there is up to you. Now, on this last page, I'm not going to do it because I've showed you guys already how I'd set it up. But I would have the S&P 500 ETF SPY. Okay, I watch SPY. SPY is a great stock to trade. Okay, in the options market. So now let's talk some actual Ooh, Facebook's tanking. Zynga must have missed. Oh, shit! No way! What a bitch. I was looking at those fucking clips. Oh, my God! Those $4 puts closed at 5 cents? Are you kidding? Guys, these are going to be up. Oh, my God. What the fuck? He's going to be up like 2,000% tomorrow. All right, sorry about that one, guys. Anybody have puts on that? Oh man. Well, anyways, well, this is a perfect lead-in to our segment on the actual stock and options itself. So let's talk basics, okay? On the left side here is the call side. Essentially what that is that's the right, you pay for the right to own the stock on the call side. On the put side, you pay for the right to short the stock. Okay. Now what comes with that right is a price, which means the price at which you are either long or short. That's the strike price in the middle. And the date at which you can choose to have been long or short at. Meaning that your contract to be long or short at that strike price is only valid if by this date the stock is either above or below your strike price, depending on depending if you're long or short. So, said a different way, by the end of this week, if you wanted the right to own Zynga at $3, you had to pay, $2.20 or so. The stock was around $5.10. So even though you had the right to own it at $3, you had to pay $2.10 or so to own that right, meaning your total cost on the stock is $5.10. Okay? Now, had Zynga gone to $7, what would we expect this $3 strike call to be sold for? Yeah. So, right, the premium would be $4. So that would have been, a 100% move in premium if it would have made that move by tomorrow. Now, what's going to happen if you were buying, let's say these $5 strike calls were going for 34 cents at the close. So what's going to happen if you bought those today with the stock down at $3.30? Why is it going to be worthless? Because it's going to be worthless, because who wants to pay to own the stock, for the right to own the stock at $5 by this Friday when it's at $3 right now? Nobody. You just wouldn't do that. God, I'm so pissed about that Zynga, guys. I was looking at those and I bought the Crocs instead. God. Sorry, I'm just really upset about that. I knew I should have put them both on. God. 5 cents. These are going to be open up at $1 tomorrow. It's going to buy 100 contracts for $500. Oh, God. So, anyway, back to the lesson. So, Zynga, right, these are going to be worthless because the stock, we see what it's doing. However, let's take the $4 strike puts, for example, which closed at 5 cents. What this is this is the right to be short Zynga at $4 by this Friday. The stock is at $3.18. So what would we estimate this premium is going to do tomorrow? Yeah, it's going to be up at least, if this is money tomorrow, what would these $4, what would the right to be short at $4 be going for? Yes, at least 80. And we get 80 because we subtract the current price of the stock from our strike price to calculate what the intrinsic value or the fair value of the premium will be. So, this is why options are so cool, because you can buy it at 5 cents and it's just like buying a penny stock, okay? You bought it at 5 cents. If it opens at 80 cents tomorrow, you can sell it. And you would sell it, okay? And these are probably going to open at $1. So that's why, options can be so rewarding on something like this. All right. So the most important part, though, is going to be understanding how to calculate your premium in terms of adding the premium you're paying to the strike price and then subtracting the actual price of the stock, or if you're doing it on the put side, subtracting the price of the stock from the strike price, or excuse me, subtracting the premium you pay from the strike price and then minus the stock also, right? Because you're shorting. God, it's below $3. That is crazy. 96K on the ask, 100K on the ask. Oh my God. 200K on the ask. I gotta take a pic of this. God, it got taken out. All right. Down 40%. Oh my God. What a piece of crap. Okay. Save that for later. So the most important parts are understanding how to calculate your premium like that. All right. Now, Zynga really isn't an ideal stock to trade options on. But let's take a stock like Netflix, which was awesome today. So on something like Netflix, a lot of times what can work is chasing momentum upwards and downwards. So Netflix, for example, and I did this today. Netflix, you had a gap down, right? Here's our gap down on the daily. And your first momentum within 15 minutes was to the downside. You guys understand what I mean by that? So Netflix, we had this, within the first 5 minutes, it started going back down, okay? So you could have chased that momentum lower on Netflix. Apple, same thing. After that first 5 minutes, you could have, it started going back down. After these big gap downs, you can chase that momentum lower because there's already momentum to the downside because of the gap down in and of itself. I mean, stocks gap because of momentum either upwards or downwards. So on Netflix today, let's take these 60 strike puts. Let's see what Crocs is doing. Piece of crap. So here are the puts. And if you want, these are a useful chart to have up as well just while you're trading. If you prefer to see not only the chart of the stock, but the chart of the particular option you're watching. You can also send that option chain to level 2 by right-clicking on it and saying send symbol to, market depth or level 2, whatever it is. So now you can see within the first 5 minutes of the day, these are the puts on Netflix, the 60 strike puts. They opened around 60 cents. And then as Netflix made this move lower, okay, just look at this explosion in premium. These puts went from 66 cents all the way up to $2. An intraday move of, over 200%. And when I say chase momentum, the strategy you kind of want to employ is you want to let a stock like Netflix kind of show you what it's doing. What I mean by that is if you just chase this momentum down until it stops going down, you can trade those puts 5, 10, 15 times in a day like today. So what I mean is here you go, first down candle on the 3-minute chart on Netflix. Down, boom, 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 12 minutes straight down action. You go sideways right here starting at 9:48. That's your first, you book those profits right away. You're out, okay? So at 9:48, those things had hit 95 some odd cents, all right? And we were all buying in the 90-cent range, okay? Because then look what happened. Here you go, goes up, but then here's your first down candle at 9:57. So you jump in there, you chase it. I see what the problem is. So at 9:57, those were around 94 cents, okay? But then at 10:03, Netflix then starts making that up move again. So you bail right at 10:03. These traded between 98 cents and $1.14, okay? Netflix up, up, up. Here's your first down candle right here between 10:18 and 10:24. So it's been showing you all day the momentum is lower. It showed you with the gap down. And the stock, if you were watching the level 2, you could just see the sell pressure. So again, you chase this momentum. If you're chasing between 10:18 and 10:21, you're getting to buy back between 60 cents and 85 cents. And that's when these things just really ripped, because once it made that last bounce, it just really unwinded straight from 63, pretty straight down to 60.50. You didn't really get a signal to take profits until 11:36. It didn't start going back up. If you look, those options had hit $1.30, so you squeezed another 30% out of them right there. And then goes sideways. Now, as soon as you break below this low, you're shorting it. I mean, it's just like a daily, guys. You look for those breaks below recent lows. So you broke this 60.58 low. We're a magnet down to 60 after something like that. So you jump in there. I believe I told everybody in chat, guys, Netflix back in play here. And when I say in play, I'm not necessarily calling out a strike for you to go buy. I'm just saying, it's in play. Find something you like and play along, because there's good liquidity and good volatility here, and we were breaking a key level. So we broke that level at 12:27. So again, we chased again, bought the calls. I bought mine for $1.30. They traded in $1.30 to $1.40 range. And then from that entry, on this breakdown, look how nice of a move down this was until about 12:54. So we wrote it again from $1.30 to $1.40 all the way up to $1.85 to $2 range. And there's numerous people who played that in chat. Okay. Now, again, what I'm showing is more kind of examples for day trading options. If you want to swing trade them, you know, that's a different story. I'm not really going to talk much about that. What I will say on that is why it's so important to know the stocks you're playing. And sitting getting active here. To know the stocks you're playing, because it'll just be that much easier to try different strategies like swing trading or something like that. Okay. Are there some general questions, more questions about strategy versus, yeah, I mean, just general strategy questions that people might have? Why do you have to swing trade until you have 25K in the account? You don't have to say. You just make a couple good day trades. I just showed you how I'm looking at all these during the day. I'm organized. I'm well organized like this, and I have my watch list over here so that I know if now something's moving that I got to pay attention to. You know, I'll jump in, and I'll just, you know, kind of swap between. I can tell you, Facebook is definitely in play tomorrow. I mean, goodness gracious, this thing is with Zynga tanking and stuff. So, you know, I'll have Facebook ready to go. But if I trade Facebook and then I notice, I look over here and I see, oh man, Salesforce is down, you know, testing 125. And I know 125 is a key level because I've watched Salesforce a lot, and I can tell you over the last couple months, 125 is an area that it might have triple bottomed from. Yeah, okay. So here we go. Salesforce 126, 125.25, 124.81, 125.29, 125.10. Okay, so again, now tomorrow pre-market, if I look over here and I see that Salesforce is breaking below 125 or something, now I can just, now I've got my other window up here from a financial, because I still want to play Facebook. Okay, and now I'm ready to go with Salesforce. Now I'm in the zone, and here we go. And again, you can set this up. You can make your windows smaller so that you can fit 2 or 3 stocks on. If you have multiple screens, you can, you know, do that. All I'm trying to show is how important being organized is. As far as which strikes to get, that's a good question. Okay, this is definitely a good question that I want to cover because there's a lot of confusion. Okay, guys, so here we go. Let's stick with this Salesforce. So we've got the 125 puts going for $1.90. Okay, and we've got the 135 puts going for $9.90. Which of these is, here, let's do a poll so that way you don't have to be embarrassed if you don't know the answer. So is the 125 strike put or the 135 strike put cheaper in terms of premium. $125, $135, don't know. And again, the 125 is going for $1.90. The 135 is going for $9.90. We want to know, is it cheaper? We want to know which one's cheaper in terms of premium. Okay, well that's good. Most people said 135 because it is the 135. And for the people who don't know, I'll explain. Remember, I said the most important thing is being able to calculate premium. Okay? So if we're looking at the 135 put, remember, what we are paying for is the right to be short that stock at that particular price by the end of expiration, which is this week. And how we calculate our premium, now yes, we are paying $9.90 to own that right. But in terms of premium relative to the stock, our average is going to be 125.10. Okay, 135 minus 990. Okay, the stock closed the day at, let's see, at 125.32. So what you're doing is you're paying about 20 cents worth of premium. Okay, because now we would take our price that we're buying, which is 135 minus 990, okay, which is 125.10, and then we would say, okay, so we're short at 125.10. That's what we own. We own the right to be short. That's the price, and the stock's at 125.30. So we only needed to drop 20 cents to, be even, to have premium start working in our favor. Okay. Now the 125, however, what is your price of the stock if you buy the 125 put for $1.90? Yes, it is 123.10. Okay. So now we're short at 123.10 essentially versus our short at 125.10. The stock is at 125.32. So with the 125 short, you need it to drop $2.30 versus the 20 cents that you needed to drop. Okay. So in terms of which one is more expensive, it's actually the 125 because you need the stock to fall further. Okay. Don't make the mistake of thinking you're not paying a lot in premium because the price for the 125 strike is lower than the price for the 135 strike. Because you have to remember what you are actually paying for. Now, where these have their risks and reward. The risk is that if Salesforce stays above 125 all week, these are going to go to zero, while these will stay pretty much break even. So this person will lose money, this person will not. The risk is also that Salesforce will drift back above 130. These will obviously go to 0. These will, drop half in value. Okay, so again, these are riskier, right? Now, the reward, though, is say Salesforce falls to 120. These 135s will go from $9.90 to $15, a nice 50% gain. Meanwhile, these 125s will go to $5 for a 150% gain. Why will they go to $5? Because the price of the stock will have fallen to 120, and we owned the short, the 125 short at 123.10, okay? So we can expect those $3.10 to then be reflected in the new price of the contract we just bought. 190 plus 310 would be $5, okay? Or another way to think about it is just the stock falls to 120, you take the price of the stock, the strike price, and subtract the price of the stock. So to get what the premium will be, what the price of it will be, I should say. So did that make sense? I mean, it's kind of hard to show that after hours. Zynga, I mean, I can tell you what's bearish. It's down 38% and it's not bouncing at all. So, like I said, though, the best example in terms of how I use level 2, you're not going to see after hours. I'll do it. I'll do it sometime tomorrow. If you've been in the big board room, I think you've probably learned a lot the last 2 days just watching Netflix. So I mean, just who as far as the Greeks, I can't answer much of a question about that because I don't know anything about the Greeks really. Uh, and again, that's why I didn't try and explain necessarily why they move, but I explained if you watch them together, the stock and the options, you'll start to get just a feel for it. Yes, you can always sell before it hits 120. I mean, if Salesforce were to go down to 123 tomorrow, those are still going to rise. You can always, always sell and buy the contracts, okay? Unless they're at 0 and they're a liquid. You can always do that. They're just like stocks, guys. You trade them just like stocks. You buy them and then you sell them, which is a good thing to show how you actually buy one of these things. So if you want to buy, you just click buy to open, okay? And then when you want to go to sell, you click sell to close. Ignore sell to open and buy to close. That's shorting premiums, which I doubt any of you, I don't think any of your brokers will allow you to do that. So just buy to open, sell to close is how you, it's just like you buy and sell button on a stock. Any other just general strategy questions or stuff I discussed? Have people found this helpful as far as options? No after hours on options at all. SPY trades for 15 minutes after hours, but no others do. I don't want to really discuss spreads. People aren't. Those types of things you learn on your own once you get the basics down. Yeah, I don't link my windows either. I just have it set up how I showed you. This is more than compatible enough. All right, guys. Anything else? I wanted to show, as far as strategy was, you know, chasing momentum. Um, so maybe I'll show another one about that, what I mean. Um, because cat was a great trade today. Cat's a good example of why the 60 minutes is so important. So cat gave up all of these gains, right? I mean, here's the gap up today. Closed at 81.45 yesterday, gapped up to 85 today, and then just filled the gap completely, actually went red. Notice this low, 80.29. It's just above yesterday's low at 80.27. So while today I was watching cat, and I played the 80 strike puts for a second, and I took a quick loss right away. And then it dawned on me that cat was right above that low from yesterday. And so I bought the 80 strike calls instead. For $1.30, I believe. And you can see that was pretty much the low. So that was between 11 and 12, or 12 and 1 when cat made that low. And again, 15-minute chart, it was right around 12:15. Got a great signal, new low, and then broke above it. So I bought those right around 12:15, I guess, for $1.30. Yeah, you could have picked these up all day between $1.20 and $1.30, from 12:10 through, or $1.40, I should say, through 12:30. And you can see, I mean, these just ripped all the way up to 325. That's a real 100% gain, just, taking an hour. But you need to be paying attention, not just looking at a daily, not just looking at, a 1 minute, because if you were looking at a 3-minute on cat, or a 5-minute, or a 15-minute, cat looked really, really bearish coming all the way down here, and it just given up all those gains. But because I had the 60-minute as well, I was able to be like, well, you know what, this is actually a great risk reward trade here, because cat is very close to its most important recent support level. And so I was able to make a nice trade there. We don't have handouts, but we are doing different changes to the site that are going to be much more much more informative and basic, that you could print out and stuff. What stocks have options that are good for beginners to learn? I mean, that's really subjective. Spy's great. I guess that would be number one. Watch Spy. Start with Spy because that's the market itself, and that'll just prepare you for a lot. I mean, my favorites that I like to trade are Amazon. I don't know if you guys, I think I said last week, like more than 50%, more than 50% of my profits on the year have come from Amazon stock, from their options. So, I think Amazon's a great stock to learn because it's been good to me. So, but in general, you want higher price stocks, okay? And I'll explain why. So take BAC, for example. I saw somebody just mention that. So BAC, here's the problem. You've got the 7 strike and the 8 strike, the 6 strike. They're between the 7 strike and the 8 strike, you know, you've got what, 15 to 18% in between those strikes, okay? So you can only choose one of them versus something like Apple where, or even SPY, since that's the example I just showed. Right? So SPY, you've got the 134s, 135s, 136s. These are, you know, within 1% of each other, okay? The higher you go, Google, you have strikes that are within 0.5% of each other. Apple, same thing. So what that's going to do is that's just going to help you that's going to help you with your premium, and that's going to help you, that's going to allow you to really choose more as far as what you want to do. It's just going to give you more options, okay? So I would recommend the higher price stocks: Google, Apple, Amazon. You know, Cap's a good one. Exxon's a good one. I did put on that Citigroup trade, but I'll tell you, I went out to September and bought the Citigroups for 91 cents, the 24 strikes. So I'm not really day trading Citi. Zynga would have been nice, you know, but yeah, Priceline's a great one, but Priceline is hard to. Priceline is make sure you watch it a while. Chipotle is good too. Yeah, Lulu hasn't been a good trade lately, but I think that might change soon with Whole Foods doing really well on earnings. Oh my God, it's up to 93s? Are you kidding? God, guys, Whole Foods, Zynga, and whatchamacallit, Crocs were the 3 I was looking at. And I chose the one that didn't do what I needed. Oh well. All right, guys. So I hope everybody got something out of that. And I do know this was recorded, so yeah, we'll get this posted.